Welcome back to Mortgage Minute. We have Frank in the studio. Again, we're going to talk about rental properties, taxes, and mortgages. Frank, how are you today?
Great.
Perfect. So, rental properties, right? People want to buy some property, buy some investment property. The way that we look at rental properties as far as income, there's different loan programs and different things that we can utilize, right? But one of the programs is we can utilize potential rental income for that property of the market value of that property to help them qualify, right? So let's translate that into your field, into taxes. When people buy rental properties, what did they have to know? What sort of tips can you give them?
Okay. When you buy a rental property, you have a different sort of tax classification that you're dealing with. You're probably familiar with mortgage interest and real estate taxes go as itemized deductions. There's what's called a Schedule E for each rental property, and that's basically a profit and loss statement for each property. So you have the rental income at the top, and then you list all your expenses, including mortgage interest, real estate taxes, and so forth. So in the context of what you're saying, it's really important to have an idea of what the potential rentals are going to be for a property. So it's worth doing some research and talking to a real estate agent about what the potential rents are on a particular property or neighborhood before you even go to apply for the mortgage.
The best thing about rental properties as far as income is concerned is that when you do your taxes, and what I see on the tax returns when I see rental properties is we can deduct the interest, we can deduct the taxes, management fees, and all that. You can apply that to your income and pay less taxes, right? What's the benefit of having a rental property other than positive cash flow?
I think the main benefit of a rental property is really as a long-term investment. One of the things we run into, particularly in the Northern Virginia area, is that if your income, adjusted gross income before the rental is greater than $150,000, you can't deduct the rental loss immediately. You have to carry it forward to a year where you have a profit, or when you sell the property, you don't lose it. Now, the way a rental property typically works is you do the profit and loss. If you have a profit, you pay taxes on it. If you have a loss on it, it then depends on what your income is. If your income's below 150, you get to deduct most of it. If it's above 150, you end up carrying it forward. But to me, the main benefit of a rental property is really the appreciation in value over time, and I would plan on hanging on with a time frame of 10 years.
Yeah, and the other thing that people don't think about rental properties is that someone else is paying down the principal. So that amortization that's happening every month, it's a savings account.
And I would also say that the mortgage payment that you have is never going to go up from a practical standpoint, but your rental income is going to go up. So you're probably in the worst situation you're going to be on day one, and it's only going to get better from there.
First year is the worst, always.
Yes.
All right, guys, there you have it, mortgage and rental properties and taxes. If you have any questions, let us know. But that's it for this episode. See you next time in Mortgage Minute. Thank you, Frank.
Thank you.